Hey everyone, Dave Allison with Allison Wealth, and in today's video, we're going to talk all about how you can stuff more money into your Roth account. See, so many of our clients enjoy having Roth money because they like the ability to defer taxes as their money is growing, and then ultimately take money out tax-free when it comes time to retire and take distributions from their accounts. But they're challenged with the limitations. With an IRA, if you're under age 50, you can contribute up to $6,500 a year into a Roth account if you're under a certain income level. If you're over a certain income level, then you cannot make direct contributions into the Roth. You need to utilize unique strategies like backdoor Roth conversions, which we'll touch on in a different video. If you're contributing or participating in an employer-sponsored 401k plan, you might have the ability to participate or choose for your employee contributions to go into the designated Roth account. Now, with a 401k plan, in 2023, you can contribute up to $22,500 into your 401k. That's the employee deferral. If you're over age 50, that amount can actually go up to $30,000. And so what's quite interesting is not a lot of people are aware that in a 401k plan, the limits are actually $66,000 if you're under age 60, or as high as $73,500 if you're over age 50. So again, $66,000 if you're under age 50, $73,500 if you're over age 50. And that's a combination of both the employee, which I have designated as EE, and your employer contribution if they're matching some money in. And so what I want to talk about is a strategy that we're going to call a mega backdoor Roth. And you might be familiar with this idea of a backdoor Roth IRA conversion. That is where you essentially are a high income earner and you make a contribution into a traditional IRA, which you might not get the deduction for if you're over a certain amount of earned income, but then immediately you can do a tax-free conversion of that amount into a Roth IRA to go from the IRA to the Roth IRA because there's no income limitations on Roth conversions. The amount you contributed into your non-deductible IRA goes on Form 8606 of your tax return and essentially creates that tax-free conversion. Now, the one thing I'll state for those of you interested in this backdoor Roth strategy, you need to be careful of something we call the pro rata rule. This is if you have other IRA money. And again, that's not the purpose of today's video. The purpose of today's video is how you can really build up even more Roth money utilizing your 401k plan. So let's assume you have a 401k plan at work and you're maxing it out. You're putting $22,500 per year into your Roth 401k because you're under the age of 50. Now, let's say on top of that, your employer matches 50%. So they are going to pony up another $11,250. Now, prior to 2024, that employer match had to go into your pre-tax 401k. But because of the Secure Act 2.0, we're now going to have the ability in 2024 and beyond for that employer match to actually go into the Roth. So if you think about that, if that law was in effect for 2023, you could technically have the $22,500 plus the $11,250 that your employer put in, $33,750 going into that Roth account. And again, that will begin starting in 2024. Now, remember what I shared earlier. If you're under the age of 50, you could actually contribute up to $66,000 between employee and employer contributions into your 401k. But if you look in this scenario, which most employees are doing, this is only $33,750. And so again, you might say, well, how do we get to this limit? How do we get to this $66,000? And simple math would tell us that if we can put 66,000 in, and between my 22,500 and my employer match of 11,250, that's 33,750. It basically says I still have $32,250 worth of capacity before I hit that IRS limit. Now, that gives us $32,250 of what's known as after-tax contribution. This is money that you're going to pay tax on, and you can contribute it into the 401k plan, assuming your 401k plan provider allows this. And so not all plan providers allow this, but a lot of them do, especially at big Fortune 500 companies. We work with a bunch of clients at big companies like Meta, Google, Apple. You look at some of the biggest companies in the country, and they allow this after-tax contribution. And essentially, you might say, well, why would I want to pay tax on my money and make an after-tax contribution into my 401k plan? Well, the beauty is the final component. What you're able to do is an in-plan Roth conversion on that after-tax contribution. And so if you think about this, let's say you're a very high income earner, you're making over $1 million a year. Well, we all know you can't contribute directly to a Roth IRA. But if you're under the age of 50 and you take advantage of that backdoor Roth IRA conversion, that is $6,500 that you can contribute into the Roth IRA through that backdoor process. From there, if you're participating in your 401k plan at work and it gives you the ability to contribute after-tax money, you could do the first $22,500 in the designated Roth account. Let's use 2023 as the calendar year. And let's say your employer then puts that 11,250 in. And I mentioned earlier in 2023, that has to go pre-tax. Well, from there, that gives us the remaining $32,250 that can go into after-tax contributions. And we could do an in-plan conversion to make that Roth money growing tax deferred, coming out tax-free later in life. Altogether, $22,500 plus $32,250. That would be about $54,750 that is going into the Roth, plus the $6,500 is the back door. Now you're just over $61,000 a year going into your Roth account, continuing to grow tax deferred, ability to take it out tax-free, assuming you follow the right withdrawals, and that could be huge to help you continue to build a tax-efficient retirement plan. So if you have any questions at all, please don't hesitate. Reach out, schedule a meeting. Our team of advisors can walk you through your 401k, your options, and help customize strategies to help you continue to build and accumulate tax-efficient wealth.